Hello there, welcome to IFA Insights, where we bring real conversations with experienced professionals to independent financial advisors navigating real decisions that affect their business. Today, we're going to talk about a topic that can confuse even the most mathematical of brains, compensation. Because when advisors start considering a move, the conversation always starts with payout. But what we've seen time and time again is that compensation is rarely as simple as a percentage. What really matters is what you keep, how your business can grow, and whether the compensation structure is helping or quietly limiting you and your long-term success. And the challenge is most advisors are evaluating compensation models without full transparency into the true economics behind them. That's why I'm really excited for today's conversation. I'm joined by John Andrews. He's ARC's Director of Growth and has a long history as a wholesaler, so he's seen the ins and outs of many, many firms, where he's been helping advisors navigate decisions to move their practices and helping them break down the compensation structures and understand what actually drives their income and value. So, John, thanks for being here. So let's jump right into it. So advisors always say they're looking for a better payout. There's usually more behind that. So from your conversations, what are advisors really saying when they focus on payout?
Good question. The old Jerry Maguire, show me the money. So if you take a step back and an advisor reaches out and says, hey, tell me about your payout, automatically red flag goes up that there's something else behind this conversation. It's not necessarily just about the payout that they're receiving. And usually you can narrow it down to a handful of things, whether it be they're unhappy with something at their firm or they talk to somebody else in the industry and somebody else has a better payout than them. They just kind of want to know what's out there and what's going on. So it's not necessarily all about the true payout. It's about what you're getting. So we can see it as, what are you getting for the value for what you're giving up and forfeiting in your income, or what we call the grid? What do those services look like? How much does each one cost? And this leads into the second thing that we usually uncover is it's more about transparency than anything else. Like the firm that they're at might not be fully transparent about what they're collecting that revenue from this producer and what they're doing with it and how much these services cost that they're being provided. So it's usually more along the lines of a transparency issue, or they're not really necessarily unhappy with their grid. They just don't know, and a lot of it is lack of education, or they moved really quickly the last time they left a firm and joined a firm really quickly for some reason and didn't really do their due diligence, which we can talk about later. But if you really sit down and look at it, it's usually a driver outside of the pure compensation.
Yeah, for sure. So when they start exploring a new firm, obviously compensation comes up really early. Sometimes that's even the lead, right? But they're still not getting it right. So what do you think advisors are getting wrong when they're evaluating those compensation models?
So there's an old adage in sports that says offense sells tickets and defense wins championship. When you see that big headline payout of, hey, we're going to give you an upper 90s payout, well, that's going to get everyone's attention, and that's really going to sell the ticket, right? But when you start looking under the hood and you start seeing how everything is built, what they're really not doing is they're not taking the time to understand what comes along with that payout, or more often than not, what doesn't come along with that payout. So it's the value that you're getting in return. So the big number gets their attention, but they don't understand that behind that there's a lack of service or support. And oftentimes the other thing that they're missing is there's hidden costs that'll be taken out on top of the grid. So there could be a platform fee that's associated with doing business on an advisory platform. There could be a franchise fee sometimes. So there's a lot of these costs that can add up that actually come out of the revenue that's being generated. So your grid, like we like to call it here at ARC, your grid is not really your grid. It's what your true grid really is after you've taken in account all of these expenses and costs.
Yeah, so let's dive into those hidden costs a little bit more.
Yeah.
So I think you mentioned platform fee.
Yep.
We've seen that in a couple of different ways. You want to go a little deeper and just what some of those hidden costs can
Yeah,
be?
so platform fee is actually the biggest one. Usually it's a fee for pleasure for doing business on our fee-based platform, our advisory platform, and it comes off the top, and that can range anywhere from a couple of basis points all the way up to over 20 basis points. It can be a big number, and when you start deducting that from your revenue, it's not part of your grid, so people don't understand it's being shaved off the top of your revenue. That actually creates this cascading effect of, okay, after the firm is taking that platform fee, now they've shaved some revenue off, now your grid's applied to that. So your true good really comes down pretty substantially if you're paying a substantial platform fee. And usually those platform fees are staggered based on the amount of assets you have on that platform. So if you have more assets, obviously your fee will be lower. But if if you're in, under 50 million, that number can be pretty substantial. So, and that's where here at ARC, we like to look at that and do that analysis. But to answer your question about some of the other fees that go along, there are some firms offer a franchise fee, and that's just an all-inclusive flat fee per year, an annual fee that allows you to use the name of the firm that you're affiliating with. Other things are technology costs, your staff costs, your operational costs like real estate. I did this back in 2010. The first cost analysis I ever did for an advisor was in 2010 when my former mentor, or my mentor at the time, who was a Merrill Lynch financial advisor, I had already moved into wholesaling and I had worked with him for a few years. He came to me and said, hey, I need to do an analysis because I'm ready to go independent. So we really broke it down and looked at all these different costs that are associated with going independent. And what we realized was, the Merrill Lynches of the world or the large wirehouses of the world, they really do have that number down to a precise number of how much they're taking. But what they're doing is those larger firms, they're offering everything under their umbrella to the advisor, and the advisor often isn't utilizing it properly. So a lot of those hidden costs, the technology, the staff, the operational, your real estate, that all, I don't want to say they're just hidden costs, but they are costs that are definitely associated with the revenue that you're giving to the firm that you're affiliated with.
Yeah, absolutely. So let's kind of make this practical for an advisor that's in that mode now, starting to ask the questions. Can you walk us through some of the most common compensation structures that you're seeing from competitors, and then what questions those advisors should be asking or paying attention to?
Yeah, sure. So I like to think of everything in the power of three, right? And there's generally three different compensation structures that we see across the industry. And it's really simplistic. It's high payout, low support, low payout, high support, and then the kind of hybrid model, which is where we happen to fall into, where you're going to get a pretty substantial payout, but you're also going to have some services provided with the ability to add more services on top. So it's pretty easy. Now, obviously, you think about the big wirehouses. They're going to be the low payout, high support. All services are being offered. The kitchen sink is included, right? And then you think about your places, your true RIA independent financial advisors that are affiliated with Schwab or Fidelity or Pershing. That's going to be very high payout, but there's no support behind that. It's on you to go out and run the business, right? We like to think that the real happy medium is that hybrid model where you're going to get a substantial payout. It's going to be significantly more than your big wirehouses. It's going to be, almost identical to the pure RIAs with some minor tweaks and changes and some different services that can be done on top of your payout. So that real sweet spot is the hybrid. And I think we're going to see a shift in the industry moving away from the low payout, high service. We're going to see more and more folks start to gravitate to the hybrid before they're ready to make that jump to pure independence with the RIA and doing it all themselves.
Yeah, there's a lot to learn when you go from the wirehouse model to the independent model. So kind of thinking along those lines, a lot of times we do see like a giant growth trend when advisors move into the independent space because they're freed up to do more of what they want to do. So when they're making that move, how can a compensation model either help them grow or potentially limit them?
Well, so I guess the first thing is every advisor is going to have a different compensation model to another advisor. And it really comes down to what works best for that advisor. So if you're a more senior advisor that's not looking to grow, then the real growth enabling models aren't really necessarily for you sometimes, but can actually be a benefit in valuation. So if you're looking to exit the industry, being an independent or a hybrid actually improves your valuation. So you may not be in growth mode, but the comp model actually can help your valuation later. For the folks that are in growth mode though, you want your comp model to allow for you to spend more time focusing on the growth of your practice versus having to manage it. And that's where you have to identify what you're getting in return for the services. Do you want to manage your costs more efficiently? And are you actually open to the true technology stack that's available to everyone? If you're at one of those large wirehouses, you can only use what's approved through those places, right? Whereas if you're hybrid or you're a true independent with the high payout, low service provider, you have a lot more freedom to use the tech stack or to use whatever marketing services are available in the industry to go ahead and create a growth model that works best for your firm. So some practices do very well in that low payout, high service model, and that's great. Probably going hybrid or independent isn't for them, but the majority of folks that we talk to and that we work with, the ideal situation is being in that hybrid model where they can have access to whatever they need to help their practice. Because again, no two practices are alike. They're going to find the sweet spot that works for them, and it's usually using services or support or strategies or technology that aren't available at one of those low payout, high services, high support structures.
Yeah, very good. So let's talk a little bit about due diligence. When they're in an evaluation stage, what are some questions advisors should be asking but often aren't?
Okay, so the biggest one that I've seen is the transition package itself. And when an advisor sees a transition offer, their eyes light up when they see that big upfront check.
Yeah.
It's easy, when some of the larger wirehouses are throwing out 3 to 3.5 times trailing 12, those eyes get really big. That's great. And I tell every advisor, if you need the money, if you have a life event happening and you need that money, go for it. Nobody's going to think twice about it, right? And nobody would blame you. But if you're really focused on growing your practice over time and you really want to do what's right for your client and for you, then you really want to look at this hybrid model or going purely independent, because during the due diligence process, you need to identify what is your practice looking for. What do you want to do with your practice in the next 5 years, 10 years, and 15 years? And you need to do that cost analysis to understand, okay, if I'm going to be doing this for 10 to 15 more years, what are my costs associated with running the business? What is my growth expectation going to be? And is my comp model going to allow for that growth? And I think when you start doing the due diligence, there's a real break even as to, was it worth it to take that upfront check? Or was it worth it to have a little higher of a grid, less upfront money, and create the tools around my practice that are going to allow us to grow substantially more in the future? Because there will be a break even, and that's part of what we look for when we work with these advisors. What's that break even? Because there's always a break even.
Yeah, don't forget, if you need the money, take the money.
Right.
But you're loaning yourself the money.
Yeah, that's all it is.
Yeah.
And there's tax implications on that too.
Yes.
But that big upfront check, Sarah, you know it.
Oh yeah. I'd take a big check today if somebody wanted to give me one.
I think we all would. It's almost like you hit the lottery.
Yeah. I could buy a couple things. So let's kind of start to wrap this up. So just from your perspective, anything else that would really define a compensation model that's going to work for an advisor long term?
So every advisor's practice, and I've kind of reiterated this multiple times, but every advisor has a different practice from the next advisor. There's no two identical practices, and it really takes a lot of due diligence and a lot of understanding what the comp model is, what are the services being offered, identify what your practice really needs, or maybe what your practice is really good at. Because you can always outsource your weaknesses too. If you're really strong at something, go outsource your weaknesses, right? Isn't that what they say, the best leaders in the world do that? Financial advisors are no different. They're great leaders at certain things, so focus on that. And then go find the firm that's going to offer the best strategic growth, the best services, the true comp model that's going to enable that growth. And here at ARC, that's one of the things that we do well. When we meet with an advisor who might not be within our network right now, we take the time to understand what their business looks like. We want to know in and out, how can we help you? What's the best comp plan going to be for you? And then what are the best services and technology and marketing going to be around you to help you grow and focus on what you want to do? That's the name of the game. And I think we'll see a shift toward more firms that are going to focus on that. I think the aggregators have had their day. I think we're probably getting near the peak aggregator world. And, at wirehouses, we obviously know that they've been losing the recruiting war for quite a few years now. So I think that sweet spot's going to be in the middle of, hey, you're going to be a true independent financial advisor with a hybrid. You're going to have a lot more services offered than where you're at right now. And your comp is still going to be very favorable compared to where you are. And I think we'll see that evolution continue to happen.
Yeah, and giving advisors autonomy, I think, is key.
Absolutely.
Yeah.
Yep.
Ask those questions too.
Yep.
How much autonomy do I really have?
Yep.
So this has been a great conversation. Thank you so much, John. We know advisors are often making their decisions with incomplete information. So when you don't fully understand the economics of your business, it's easy to make a move that looks really good up front, but you're unhappy with a year or two down the road. So at ARC, we believe advisors deserve transparency, flexibility, and a model that evolves with them, not one that they will outgrow. So if you're an advisor evaluating a current firm or considering a move, take the time to look beyond just your payout. Understand your true income, your growth potential, and the long-term value that you're going to be building. So to help with that, we actually have a compensation comparison worksheet to help with evaluating your current model and potentially some other models you may be looking at as well. So if you want to learn more about that, be sure to like and subscribe to IFA Insights. And then we'll see you back here for more candid conversations designed to help independent advisors make smarter, more confident decisions. See you next time. Thank you.